What is an index fund? An index fund is a type of mutual fund or exchange-traded fund (ETF) designed to replicate the performance of a specific financial market index. Index funds are passively managed, meaning that fund managers do not actively pick stocks. Instead, they aim to mirror the performance of a specific index by holding the same stocks or other securities in the same proportions as the index. John C. Jack Bogle, the founder of the Vanguard Group, popularized index funds. Bogle, born in 1929, was an American investor, business magnate, and philanthropist. He is widely recognized for his efforts to make investing more accessible and cost-effective for the average person. Bogle launched the first index fund in 1976. Common benchmark indices include the S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100. For example, an S&P 500 index fund will aim to hold all 500 stocks in the S&P 500 in similar proportions. By investing in an index fund, investors gain exposure to a broad range of companies or securities, reducing the risk associated with investing in individual stocks. Because index funds do not require active management, they typically have lower expense ratios compared to actively managed funds. Lower costs mean more of the investor's money is working for them, potentially leading to higher returns over the long term. Since index funds aim to replicate the performance of an index, their returns are generally very close to the returns of the benchmark index minus the fund's expenses. Index funds tend to be more tax efficient than actively managed funds because they have lower turnover rates, fewer trades, resulting in fewer capital gains distributions. They can't outperform the market because they are designed to match it. If the overall market declines, the index fund will also decline. Fund managers can make changes to the holdings based on market conditions or individual company performance. You can invest in index funds through brokerage accounts, retirement accounts like IRAs and 401ks, or directly with mutual fund companies. Several index funds have proven to be successful over the years, offering consistent returns and gaining popularity among investors. Here are some of the most successful and well-regarded index funds. Vanguard 500 Index Fund, VFIAX, which tracks the S&P 500 with an expense ratio of 0.04%. Fidelity 500 Index Fund, FXAIX, which tracks the S&P 500 with an expense ratio of 0.015%. Schwab S&P 500 Index Fund, SWPPX, is another ETF that also tracks the S&P 500 with an expense ratio of 0.02%. Vanguard Total Stock Market Index Fund, VFIAX, which tracks the CRSP US Total Market Index with an expense ratio of 0.04%. Fidelity Total Market Index Fund, FXAIX, which tracks the Dow Jones US Total Stock Market Index with an expense ratio of 0.015%. Vanguard Total International Stock Index Fund, VFIAX, which tracks the FTSE Global All Capex US Index with an expense ratio of iShares Core S&P 500, ETF IVV, which tracks the S&P 500 with an expense ratio of 0.03%. SPDR S&P 500 ETF Trust SPY also tracks the S&P 500 and has an expense ratio of 0.09%. SPY is heavily used for option traders. Index funds are good for someone who is busy and doesn't want to be hands-on in the market. I'm not an investment consultant, so it's best to speak to a licensed broker when investing your money. I just wanted to explain index funds and the most popular ones. Nouriel, Gino, Yazdinian.